All right, so today I wanted to make a video about a stock that I've never actually talked about before. This is Moodys. This is one that I am not buying because it's too expensive, but I do think it's a really good company. First things first, if you get value out of the video, please like, subscribe, comment, and check out those links below. So getting right into it here, it's a $76 billion company, so definitely on the large cap space. It's in the financials sector. Dividend yield's a little below 1%, free cash flow yield 3.3, earnings yield about 2.69. So Moody's engages in the provision of credit ratings, research, tools, and analysis to the global capital markets. So that's pretty much what they do. And getting right into it here, the first reason that I really like this company is I think this is an area of the financials industry that isn't appreciated as much. I mean, you talk to the average person, what are they interested in? They're interested most likely in banks. But I mean, after that, maybe it's the private credit companies. But I talk a lot about insurance. I think that's probably the most, I think that is the most underrated area of the financials, maybe even the whole market, but definitely the financials sector. But I think that companies like this definitely fall into that as well. Now, this is more of a growthier name. Insurance companies don't typically trade at high premiums. This one does trade at a high premium. So they're different in that sense, but they're similar in the sense that I think they're underrated. So let's get right into it here. If we look at the insights, pretty good here. I mean, the profitability numbers are off the charts here. Very, very good profitability numbers. Management also doing a pretty good job. Financial health, I mean, a current ratio of about 1.5. I'm not necessarily concerned there. Growth is also very good. Basically, all of those numbers are very, very good. They're projected to grow earnings 29% next year, revenue 10%. Analysts are very bullish, so I very much like that. They do trade, their current PE is just over 37. The 5-year average is about 36.4. Average price to free cash flow just over 30. 5-year average is about 35. So they are, to me, that's just too expensive. Like, you need to be growing insanely fast to justify that multiple, even though based on these numbers, they're probably about fair value, and especially given analysts are incredibly bullish. I'm not buying here, even though analysts are overwhelmingly bullish on this. I'm not buying. Because to me, like, I don't think I could ever I'm sure there's exceptions, but I don't think I could ever buying a company above a price to free cash flow or a PE of 30. Like, to me, that's just way too expensive. Like, unless it's especially for a larger name, like if this was like a $2, $3, $4, $5 billion company, maybe, but a company this large, it's going to have to grow really, really phenomenally to justify that high of a price. So that's the one caveat. I like virtually everything about this company, but I'm not buying it right now just because I think it's too expensive. So let's check out the financials here, because this is really the bread and butter at the end of the day. So if we look at the income statement, revenue has grown quite nicely over the last decade. It's pretty much a steady staircase higher, which is exactly what you like to see. Revenue has grown about 9-10% a year over that time. Another thing I really like here is they're buying back shares consistently. Now, they're not doing it super aggressively, but they're buying back about 1% of their shares annually, which, frankly, I really like that. You don't necessarily need to be super aggressive with that. If you can maintain that 1% a year, I very much like that. Earnings also, it's not quite at an all-time high. Technically, their all-time high was back in the last quarter of 2021, but they have almost 3x'd their earnings over the last decade, which I very much like to see. So no concerns there. And then if we get into their metrics here, if you look at their profitability metrics, they're all pretty much flat. I mean, operating margin is down ever so slightly. Net margin's up slightly over that time. If you look at the free cash flow margin, I mean, 35, it's basically in the 20s or 30s every year. I mean, the lowest it's gotten in the last 5 years is about, 20% roughly. So I very much like that. That's still, they're still very profitable. Return on equity is also extremely, extremely good here. These numbers are skewed because it looks like a quarter back in 2019, their return on equity was 1,000%. But I mean, going back about 5 years, the lowest their return on equity gets is about 47%, which is extremely, extremely good. So this is a very, very profitable company. And that's something that you really like to see. You like to see companies that they don't have to put in a ton of work to make their money. That it's a fairly simple business that kind of like your Visas of the world and MasterCards are probably the best example of this. Like they have virtually no capex, but yet they're making a ton of money. And those are very, very appealing businesses. And even though this company, like they're not growing insanely quickly, I think that's why this is why this company trades at such a premium, is because they grew earnings at about 10%, revenue about 9%. Like that's not crazy good growth by any means, but they're so profitable. That's why they trade at a premium. Also, if we look at their free cash flow per share, I think this justifies a bit of a premium as well. That's easily at an all-time high. Going back about 3 years or so, that's gone up more than 2x. So that's very good to see. Their free cash flow is up again almost 3x over the last 5 years. So they're still growing good. Not the greatest growth you'll ever see, but it's still very good. So based on that, the last thing let's check on here is the dividend before I forget that. Payout ratio is about 33%. Based on free cash flow, it's about 27%. Like I said, the current dividend yield is about 0.88%, and they're growing it almost between 10 and 11% per year, which is also exactly what I'd like to see. Companies that grow their dividends consistently year after year after year, they buy back a consistent amount of shares year after year after year. Those are the companies that I really, really like, because at the end of the day, stocks are very hard to predict. And when you have a company that's grown their dividend and grown and bought back a certain amount of shares consistently for the same amount for a decade or two, it's not a guarantee, but it's a heck of a lot more likely than your average company to predict. So the last thing I'll touch on here, they've almost doubled the S&P over the last decade. They're up about 400%. The S&P is up about 210 over the last 5 years. They're actually about the same. So, and they actually came down even more back in 2022 after that crash. So if you would have bought them back then, you would have actually done pretty good. They actually had negative returns for about a 2-year period or so there. So that's something to keep in mind too, that again, there can be 2-3 year periods, maybe even longer, where companies underperform. So the last thing I wanted to get at here is the price. Like what do I think it's worth? So if we say they're going to grow earnings at 10% per year, they're going to buy back 1% of shares, they're going to grow the dividend 10% per year, they're going to trade for a 30 PE, which is less than the 35 average. So you would probably say that if anything, these are probably slightly conservative, but that's what I like to do just to be safe at the end of the day, because you're going to be wrong very often about this kind of stuff. And in this situation, if you turn out to be too bearish, well, great, you end up looking really good. But if you're not bearish enough, then you want to make sure there's a little bit of breathing room there. So based on my calculations, the stock is to come down about just under 12%, which is about $375. They are currently at $425 roughly. So let's check and see here. The 52-week range is between 360 and 530. The last time they were around 375, they were actually just below 400 that was about 2 weeks ago. The last time they were at fair value, at least based on my calculations, was almost exactly a year ago, like just early May, late April of last year. So they are actually down. One of the ways I notice this is they're down about 18% from their highs. So they're definitely not, I would say they're not overvalued. They're probably slightly, they're slightly overvalued, I think, but they're not crazy overvalued, based on the fact that they're trading almost exactly at their historical valuations. But like I said at the start of the video, I can't justify anything over like a 30 PE or like a 30 price to free cash flow unless it's a smaller company that's growing like insanely quickly, which this company definitely, they're growing pretty solidly. They have very good profit margins, but they are a larger name. And something also to keep in mind too is that the larger a name, the harder it's going to be to grow, right? Like for a $1 trillion company to compound their earnings at 10% per year, to compound at a 10% per year growth rate over a decade, it's a heck of a lot harder than a $10 billion company compared to a $1 trillion company, or even a $1 billion company, right? Because again, that growing that market cap, it's really hard to do when you're already a big company. Now, they're not crazy big by any means. They're not even 100 billion, but to 10x, that puts them at about, $750 billion, which is, I don't know if there even is a financials company that large, other than maybe JP Morgan, but I mean, technically is Berkshire Hathaway. I'm not sure what they are off the top of my head, but that's just the last thing I'll leave it on here is I very much do like this company. The one caveat, they're just too expensive, but they are a phenomenal company. I think they're a good way to diversify as well, is that how many average Joes do you know that own a company like this? Like, incredibly small amount. Like, if people own financials companies, they're almost always banks. And not that banks are a terrible investment necessarily, but the big ones, I mean, they're kind of boring. They're just not as good as, there's just better options. It's not that they're bad investments. There's just better options. And especially in the States, considering how competitive things are, that's another reason that I kind of steer clear of virtually all banks in the States. And in Canada, for that matter, as well. But I do really love EQ Bank. But I just think that's because their business model is just really good, and I think they're gonna eat the big banks. Not that they're gonna be bigger than a TD or an RBC, but I think that they're just easier. It's just easier for them to grow. Their margins are better. Their CapEx requirements are less, so that's why I like them. But that's a whole different video in and of itself. So anyway, that's what I wanted to leave it at. That's where I wanted to leave it at today. If you liked the video, please like, subscribe, comment, check out those links below. Very much appreciate all the support, and stay tuned for more.